Hello everyone, welcome to weekly lecture videos. In this video, I start discussing chapter 13, leverage and capital structure decision. A firm's capital structure decision involves the firm's choice of how much debt it should have relative to its equity. Such a choice has many implications for a firm and is far from being a settled issue in either theory or practice. So in this chapter, we discuss the basic ideas underlying capital structure and how firms choose them. A firm's capital structure is really just a reflection of its borrowing policy. So should we borrow a lot of money or just a little? At first glance, it probably seems that debt is something to be avoided. After all, the more debt a firm has, the greater its risk of bankruptcy. The impact of dividend imputation in Australia and New Zealand for resident shareholders adds to the issues management must consider. A good understanding of the effects of debt financing is important simply because the role of debt is so misunderstood and many firms are far too conservative in their use of debt. Having said this, we can also say that firms sometimes are in the opposite direction, becoming much too heavily indebted with bankruptcy as the unfortunate consequences. Striking the right balance is what the capital structure issue is all about. So we will discuss this in this chapter. As usual, we have a few learning objectives. So we will start the chapter with discussing the effect of financial leverage. Then we will see the impact of taxes and bankruptcy on capital structure. We will continue discussing the essential process of bankruptcy, and we will conclude this chapter explaining optimum capital structure. So in this video, I will mostly concentrate on the effect of financial leverage. First of all, the capital structure question. How should a firm go about choosing its debt equity ratio? Here, as always, we assume that the guiding principle is to choose the course of action that maximizes the value of a firm's share. However, when it comes to capital structure decisions, this is essentially the same thing as maximizing the value of the whole firm. And for convenience, we will tend to frame our discussion in terms of firm value. In the previous chapter, in chapter 12, we discussed the concept of firm's weighted average cost of capital, WACC. And you may recall that WACC tells us that the firm's overall cost of capital is the weighted average of the cost of the various components of the firm's capital structure. When we describe the WACC, we took the firm's capital structure as given, right? Thus, one important issue that we will want to explore in this chapter is what happens to the cost of capital when we vary the amount of debt financing, the debt to equity ratio. A primary reason for starting the WACC is that the value of the firm is maximized when the WACC is minimized. To see this, recall that WACC is the discount rate appropriate for the firm's overall cash flows. Since values and discount rates move in opposite direction, minimizing the WACC will maximize the value of the firm's cash flows. Thus, we will want to choose the firm's capital structure so that the WACC is minimized. For this reason, we will say that one capital structure is better than another if it results in a lower WACC. Further, we say that a particular debt equity ratio represents the optimal capital structure if it results in the lowest possible WACC. This optimum capital structure is sometimes called the firm's target capital structure. So to understand this optimum or the target capital structure, we first of all need to understand the impact of financial leverage on the payoffs to shareholders. Okay, so leverage essentially means the use of debt in the firm's capital structure. Okay, um, and sometimes we change the proportion of leverage, the proportion of debt in the capital structure, which is known as capital restructuring. That means changing the amount of leverage. So we can increase leverage by borrowing more, okay, by issuing bonds or by directly borrowing from financial institutions, and by repurchasing our outstanding shares. Okay. On the other hand, we can decrease our leverage by issuing new shares and retiring our outstanding debt. Now, to understand the effect of financial leverage, we will first see that how leverage affect earning per share and return on equity of a firm. Let's start by illustrating how financial leverage works. For now, we ignore the impact of taxes. Also, for ease of presentation, we describe the impact of leverage in terms of its effect on these two factors, as I mentioned, EPS and ROE, return on equity. These are, of course, accounting numbers as such, and not our primary concern. Using cash flows instead of these accounting numbers would lead to precisely the same conclusion, but a little more work would be needed. Okay, so we will understand the impact of leverage on market values in a later section. So let's start with an example. Okay. Eagles Air Service currently has no debt in its capital structure. Okay, you can see that its debt is zero. The CFO, Ms. Morris, is considering a restructuring that would involve issuing debt and using the proceeds to buy back some of the outstanding equity. So you see in the table both the current and proposed capital structure, and as shown, the farm assets have a market value of, you see, $8 million and 400,000 shares outstanding. Okay, because Eagles is an all equity farm, the share price is $20. Okay, per share is $20. The proposed debt issue would raise the debt to $4 million. You can see debt is $4 million and the interest rate would be 10%. Since the share price is $10 per share, the 4 million new debt would be used to purchase 200,000 shares. That means buy back 200,000 shares, so leaving 200,000 shares outstanding. And after the restructuring, Eagles Air Service would have a capital structure of 50% debt. You can see 400,000 debt and 4 million debt and 4 million equity. So 50% debt, 50% equity. That means debt to equity ratio would be 1. Also notice that for now, we assume the share price will remain $20. To investigate the impact of proposed restructuring, Ms. Morris has prepared another table, which is this table 13.2, which compares the firm's current capital structure and the proposed capital structure under 3 scenarios. The scenarios reflect different assumptions about the firm's future EBIT. Under the expected scenario, you see this is the expected scenario. Under the expected scenario, EBIT is $1 million. In the recession scenario, EBIT falls to 500,000, and the expansion scenario, EBIT rises to 1.5 million. To illustrate this calculation in this table, consider this expansion case. Okay, consider this expansion case. The EBIT is $1.5 million with no debt in the current capital structure and no taxes. The profit is 1.5 million, 400,000 shares worth 8 million in total, and EPS will be 1.5 million divided by 400,000 shares. So EPS is 3.75. Okay. Since accounting ROE is profit for the year divided by total equity, ROE is 18.75%. Okay. Now, with 4 million in debt, that means the proposed capital structure, this is what I'm talking about. The things are somewhat different. Okay. So since the interest rate is 10%, now interest bill will be 400,000. With the EBIT of 1.5 million, profit is 1.1 million. Okay. With no taxes. Now there are only 200,000 shares, okay, because 200,000 shares will be bought back. So 200,000 shares will worth 4 million. As a result, EPS will be $5.5 per share versus the 3.75 share that we calculated above. Furthermore, the ROE also increases to return on equity because the equity now decreases. So return on equity is now 27.5%. This is well above the 18.7% that we calculated for the current capital structure. The impact of leverage is evident in this table. Okay, when the effect of the restructuring on EPS and ROE is examined. In particular, the variability in both EPS and ROE is much larger under the proposed capital structure. Okay, you can see that EPS varies from 1.25 to 3.75, whereas here the EPS varies from 0.5 to 5.5. Okay, so this illustrates that how financial leverage acts to magnify gains and losses to shareholders. Okay, which means that this leverage increases volatility, increases risk. So there is potential for gain, but there is high potential for losses too. You also see that ROE ranges from 6.25 to 18.75 before the restructuring. And here it's from 2.5 to 27.5. So it's a high volatility after the restructuring. Okay, so this is the point that I just indicated, the variability in ROE and variability of EPS. Okay, so both of these variability increase due to introduction of financial leverage in the firm. So which means that the bottom line is the financial leverage increase the riskiness, but that also increases the potential for higher profitability. So we will look a more closer look at the effect of proposed restructuring when we examine the break-even EBIT. Okay, so break-even EBIT essentially is the one where your EBIT is just enough to pay your financial expenses. Okay, so we explain it more detail here. So you can see that EPS is EBIT divided by number of share, and EPS after is EBIT minus interest expense, because after introducing the leverage, you have interest expense and number of share. So break-even EBIT is EPS after into the number of shares. Okay, so the break-even EBIT, once again, theoretically, as I said, that's just enough to pay out your financial expenses. So this is how we calculate our EBIT and also the EPS. This break-even EBIT and EPS example for different capital structures can be better explain using the diagram in the next slide. So you can see here, this figure plots earning per share, which is EPS. You can see here earning per share against EBIT, and the earning before interest and taxes for the current and proposed capital structure. The first line, which is no debt line, represents the case of no leverage. And this line begins from the origin, you can see, indicating that EPS would be 0 if EBIT were 0. Okay, so if EBIT is 0, EPS is 0. From there, every $400,000 increase in EBIT increase EPS by $1. Okay, because there are 400,000 shares outstanding. Okay, do you understand this point? So you see that if EBIT is 800,000, then your EPS is 2. So if it is 400,000, then your EPS is 1. So if it is, for example, 1,200,000, so it will be 3, which means that every 400,000 increase in EBIT will increase your EPS by $1 due to 400,000 share outstanding. Okay. The second line, this blue line, represents the proposed capital structure. Here, EPS is negative if EBIT is 0. You can see when EBIT is 0, its EPS is negative. This follow because when you have this leverage, you have 400,000 of interest that must be paid regardless of the firm's profit. And since there are 200,000 shares outstanding, your EPS will be -2 per share, as shown. Okay. Similarly, if EBIT were 400,000, that EPS would exactly be 0. Okay. So if your EBIT is 400,000, then EPS would be 0. Why? Because that 400,000 will be used to pay out your financing cost. Okay. And if your EBIT is 0, your EPS is negative as you need to pay the financing cost. The important thing to notice in this figure is that the slope of the line in the second case, that means in the blue line, the slope is steeper. So in fact, for every 400,000 increase in the EBIT, the EPS will rise by $2. Okay. You remember previously I said that it will rise by $1, but now it will rise by $2. The line is steeper. This tells us that EPS is twice as sensitive to changes in EBIT because of the financial leverage was employed. Okay. Another observation in this diagram is that that the line, look at the line intersects. Okay. Line intersects. At this point, EPS is exactly the same for both capital structure to this point. Note that the EPS is equal to EBIT divided by 400,000 in the no debt case. Okay. And in the with debt case, EPS is EBIT minus 400,000 divided by 200,000. So if we set these equal to each other, then EBIT is 800,000, the one that I have shown you in the previous slide. Okay, so when EBIT is 800,000, EBIT is 800,000 here. So your EPS is $2 per share under either capital structure. This is labeled as the break-even point. So we also could call it the indifference point. So EBIT, if EBIT is above this level, leverage is beneficial, right? And if it is below the point, then it is not. Okay, so these are the points were mentioned here. Okay. And there is another and more intuitive way of seeing why the break-even point is 800,000. Notice that if the firm has no debt and its EBIT is 800,000, its profit for the year is also 800,000. Okay, so in that case, ROE will be 10%. This is precisely 800,000 profit divided by 8 million shares. So 8 million equity. So 10%, and this is precisely the same as the interest rate on debt. So the firm earns a return that is just sufficient to pay interest. Okay, so that's the point I mentioned previously. Okay, so let's move on. Now, corporate borrowing and homemade leverage. Based on the two tables we have seen so far, tables 13.1 and 13.2, and the figure 13.1, Miss Morris draws the following conclusions. Okay, so what are these? These are the effect of financial leverage depends on company's EBIT. When EBIT is relatively high, leverage is beneficial. Under the expected scenario, the leverage increases the return to shareholder as measured by both ROE and EPS. Shareholders are exposed to more risk under the proposed capital structure since the EPS and ROE are much more sensitive to changes in EBIT in this case. And because of the impact of financial leverage, on both the expected return to shareholders and riskiness of the shares, capital structure is an important consideration. Okay, the first three of these conclusions are clearly correct. Okay, does the last conclusion necessarily follow? Okay, so the first three one. Okay, first three one. Surprisingly, the answer is no. As we discuss next, the reason is that shareholders can adjust the amount of financial leverage by borrowing and lending on their own. And this use of personal borrowing to alter the degree of financial leverage is called homemade leverage. Okay, so homemade leverage means the use of personal borrowing by the shareholders to alter the degree of financial leverage. Okay. Now, let's illustrate this. It actually makes no difference whether Eagles Air Service adopts the proposed capital structure because any shareholder who prefers the proposed capital structure can simply create it using the homemade leverage. Okay, so let's start with the table 13.3a. This shows that what will happen to an investor who buys $2,000 worth of Eagles Air Service share if the proposed capital structure is adopted. Okay, so 200,000. This investor buys 100 shares. Okay, 100 shares, as the table 13.2, we have seen previously that EPS is 0.5 or 3 or 5.5. So the total earning of 100 shares will be 50 or 300 or 550. Okay, so you remember these earning per shares. Okay, in different scenarios. So earning for 100 shares will be this. Okay. Now, suppose Eagle Air Service does not adopt the proposed capital structure. Okay, so in this case, the EPS, this is the original capital structure. So EPS is 1.25, 2.5, and 3.75. Okay, now this table, I mean 13.3b, this table demonstrates how a shareholder who prefers the payoff under the proposed structure can create them using personal borrowing. To do this, the shareholder borrows $2,000 at 10%. Okay, our investor uses this amount along with the original $2,000 to buy 200 shares. Okay, 200 shares. So essentially, this is the earning from 200 shares. Okay, so the investor has $2,000 of his own and borrow $2,000 at 10%. So by 200 shares at $20 each using 4,000. Okay. So now you can say that how did we know to borrow 2,000 to create the right payoff? Okay, so we are trying to replicate Eagle Air Services proposed capital structure at the personal level. The proposed capital structure result in a debt equity ratio of 1. You remember that the proposed capital structure of the company was debt equity ratio was 1. To replicate this capital structure at the personal level, the shareholder must borrow enough to create the same debt equity ratio. And since the shareholder has $2,000 of equity to be invested, so borrowing should be another $2,000. Okay. And you can see that if this was the earning per share, so the total earning from 2,200 shares will be this, and you have to pay 10% interest that you have borrowed, and your net payoff is this, okay? And this is exactly equal to the net payoff if the company adopted the proposed capital structure and you would have 100 shares. Okay, so this example demonstrates that investors can always increase financial leverage themselves to create a different pattern of payoffs. It does makes no difference whether Eagles Air Service choose the proposed capital structure. Okay, so I think you understand by this time why this point number 4 was questioned, that whether it is important or not. Okay, so this is the end of our discussion in this video, the effect of financial leverage. Thanks for watching.